best investor is the investor that doesn't lose money. I'm making obviously a theoretical statement, like, there's no investor that never loses money, but conceptually, if you knew a way to never lose money, you could invest on coin flips or on securities you know nothing about because your risk management is so good.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Hi, everyone. Welcome to IBKR Podcast. I'm your host, Jeff Praissman, and it's my pleasure to welcome Giuseppe Sette, one of the co-founders and president of Toggle AI. Giuseppe graduated with an MS in electrical engineering from La Sapienza University and an MBA from Wharton, as well as holding a patent in acoustic propulsion via ultrasound. Welcome, Giuseppe. Thank you for joining us.
Well, thank you for having me. It's always a pleasure to be speaking with the IBKR folks.
Prior to co-founding Toggle AI with Jan Szilagyi, who we've been fortunate enough to have in the studio a few times, both of you were co-CEOs of Global Macro at Lombard Odier. And you also spent some time at Brevin Howard, Davidson Kempner, and at Bain, Italy. So today, we're going to discuss using options to improve investment outcome. So Giuseppe, let's start with some of the benefits of trading options.
Absolutely. Options are a main staple for professional investors, and they're also very popular retail traders. In my career, I've traded options for a good part of almost 2 decades, and I find them useful. I find them even mentally stimulating, but you need to know what they're for, what they do for you. Options are effectively, in the simplest terms, a way to outsource your risk management. Let's start from the simplest basics. Imagine a classic call option on your favorite stock, Tesla, since that's most likely to be someone's favorite stock. As you guys know, Tesla options represented almost half of all volumes of options in the US. You buy a call option on Tesla, and what you're saying is, I don't want to worry about the downside. Can someone manage this for me? And the market is there for you. And they say, sure, we'll do that. No problem. Here's the price. The key thing that options do for you is that they help you avoid some of the classic fallacies of investing. It's very, very easy for both, if you want non-professional traders, but also for retail traders, to fall into classic fallacies of risk management. The market is an emotional affair. When you're losing money, it's a skill to keep your head straight. And options, in a sense, allow you to do that with much more calm because you've paid your price for insurance. You know what you're going to lose. When the market is imploding, you're thinking, okay, well, you know what? I almost got away scot-free because I just paid my premium and that's the most I can lose. And that puts you in a better spot than having bought your Tesla share outright and seeing it tank, 20% in a week, which Tesla can easily do. And by no means this is only applied to Tesla, but it's a good example because it's popular. So getting back to where I started, the options are fantastic because they're a way to go and offset your risk management tasks to someone else. It works well if you're a day trader because day traders can have two main issues. One is that the market can be extremely volatile intraday, leaving you sometimes shell-shocked, especially in days when there is news flow. And two, sometimes you cannot be on the market continuously. But options, they're always fantastic. They're also fantastic for swing traders. You have your view, your directional hypothesis, or your volatility hypothesis. You set it on with your option structure, and then you just wait and let your swing play one way or another. Obviously, the good aspects of options don't stop here. The other fantastic thing that options let you do is compose them. You can really tailor your view of the market and your view of risk in such a way as to be precisely, almost surgically, where you want to be. So this is all that's fantastic about options, but we need to make a disclaimer. It's not even the other side of the coin. It's just we need to dispel a myth. There's no alpha per se in options, and for a good reason. So what do we, in the industry, what do we mean when we say alpha? We mean intrinsic returns that you can recurrently extract from the market. Alpha starts from like some financial mathematics that I'm not going to get into, but effectively it tells you your extra return on the market, meaning everybody can get the return on the market. Just buy the market. But if you can do better than the market, in financial mathematics, it's called alpha. And nowadays, you'll hear it used as the return you can generate without being bound to the market and to other risk factors. So you hear me use that term through this conversation, but in this specific case, what I meant when I said that there is no alpha in options, I meant that there is no way to consistently and simply do something with options, let's say buy a call spread, buy a put spread, and we'll get into what these terms mean, and just make money. And the reason for this lack of alpha, which means of stable, exploitable returns, is that these options are priced by extremely bright and very motivated quants in all the top banks and all the market makers. They know exactly what they're doing. They've been backtesting these options for a good part of the last 40 years when options became popular. And I can tell you that anybody here on this podcast, listening to this podcast, can go online, go on the site of CBOE, buy the option time series of any stock that you like. Try to backtest them in whichever way possible. You will find that consistently, no matter what the level of volatility, what your strike is, options are fairly priced. You need to have a view to make money with options. Having said that, they are fantastic.
Now, of course, with all investing, there's risk and rewards, and you definitely covered some of the rewards, and it seems, mostly speaking, about being long premium in those options as well, where the risk is only your premium that you paid for the options. Obviously, a whole other risk if you're selling premium, where if your view is wrong, there could be very high losses or somewhat unlimited losses if you sell a call, for example. But besides for, I don't know if fairly priced would be your downside, but what are some of the other risks or downsides to trading options?
It's a good question. Let me start from where you correctly prompted me to elaborate. So far, we've talked about the fact that if you buy options, you know your downside. Easy peasy. A call costs you $3. That's $300 you can pay the most. I'm saying 300 because, as most on the podcast will know, usually there is a multiplier around the option, usually $100. So if you see a screen price of 3, it means that you have to shell out 300 to buy the option. In reality, you can do some very fancy mathematics, or if you want geometric drawings with options. You can buy a call at the money, and at the money means that you can make money from where the stock is today. And I say stock, it could be oil, it could be a S&P 500 index, whatever. Options are available on almost anything. And then you could sell option 2 calls in the same position out of the money. Now let me reiterate what I'm saying. You're taking a position that makes you money right away. From here, if the stock goes up, you profit, aside from the premium you paid. But then you say, but my God, this premium is so expensive. I want to cheapen it out. A still very safe thing you could do is to say, well, you know what? I don't need to make money beyond 5% profit. So you can sell the rest of the profit. From here to 5%, you make money. Beyond 5%, you don't make money anymore. All of a sudden, you have deployed much less risk, much less premium, and your risk return is very clear to you. Let's say if it's at the money, you're probably like paying 1 and getting a risk return or less, getting a profit of maximum less than 1. By the way, calls are structured. But you can do more. To your point, you can start to say, what if I sell more than 1 call? What if I accept to lose money beyond, let's say, 10%? All of a sudden, you find yourself back in the position of having both long or so short a security. And why is that important to understand? It's important to understand because the risks in those cases end up becoming not necessarily infinite, but extremely uncontrolled. That brings you back to where you started. If you want to take that kind of risk, you can very simply take the stock outright and watch it, because you don't have a completely outsourced risk management anymore. It's an interesting way to play. I'll talk about it later about some of the options that people option structures that people like to play and that sometimes blow up in the face even of professional investors. But before we go there, there's a second risk that we need to talk about: delivery. An option, as they say, read the fine print. An option is a contract. A contract to deliver to you a certain whatever at a certain price. So we call it underlying because it's a contract, and underlying the contract as a security. If I have a Tesla option to buy Tesla at let's say $1,000, it means that on expiry I have the right to buy Tesla at $1,000. The counterparty has the obligation, if I exercise that right, to actually sell it to me at that price. Now, what happens to some traders, and this has been sadly in the news in the boom days of GME 2020, when there was like this great inflow of young traders in the market that still needed some guidance and some, if you want, like education about markets. This has been the source of some serious losses, and in one case, even suicide because of this. One trader in particular traded a call spread. Call spread is what we discussed just a moment ago. It's a structure made of one long call and one short out of the money call. Imagine in the case I was making, you say, I'm going to buy the upside of Tesla from 0 to 5% up, and then I don't need the rest. When you do that, you are convinced that your maximum loss is the price of the call spread. You are right, and you are wrong. You are right because up to the moment of expiry, there's no more that you can lose. If Tesla collapses to 0, whatever you paid for the call spread is what you paid. However, the day when the spread settles, there is a small but non-zero risk that Tesla expires squarely in the middle of that call spread, between the 0 and 5% profit. I'd say 2.5% to make it simple. Then something technical and somewhat nasty happens. You get delivered whatever amount of stocks was in your bet. And this can get tricky because a 5% call spread, especially on Tesla, is very cheap. You could have spent like, I don't know, a couple of grands to make your bet. You don't realize that that's probably like a $300,000 position in notional that gets delivered to you at expiry. Now imagine this. At that moment, you have the flip of a coin because you get delivered, it's Friday, market is closed, see you Monday. Monday, Tesla could open up 3% or down 3%. And you have a gigantic position. What's the lesson of this? The lesson is to always close your options before expiry, because you, especially in stock space, you should never take delivery, unless you know exactly what you're doing. So I think that like these two examples we've talked about boil down to not understanding your risk. Options are fantastic to contain risk, but to do so, they're double-edged in this sense, because if you don't understand how they're containing risk, you might be on the wrong side of the trade.
Right, and a lot of people may not understand. They should understand the multiplier effect with the the standard 100 shares of stock but if they don't, that situation can happen. You have a ton of investment experience. Besides for obviously your philosophy on handling option spreads, could you also share with our listeners your philosophy on investing? Like specifically, we discussed alpha a little bit earlier, just kind of the definition but also like the structuring and then, reloading basically there to kind of fight another day, for lack of a better word.
Yeah. No, it's an excellent way to say it. I think that these are the three sides of the same triangle. So we're going to talk about alpha, which is how to make money in a stable fashion, whatever the market does. Then we're going to talk about structuring, which has been the core of what we discussed, and then reloading. Alpha is effectively the product of your investing style, and there are many investing styles. Most people, if they're listening to a podcast about option, might be familiar maybe with Warren Buffett and his value approach. I mean, I don't think Warren Buffett has been value for like a few decades. He's been more of a growth at the right price kind of guy. But in any case, he's price sensitive. There are people that like me and like the grandees of the space that we worked in, like George Soros, Tudor Jones, of course, Stanley Druckenmiller, who is an investor in Toggle. We trade global macro, which means that we take views on the large benchmark indexes and gauge where they might go based on where the economy is going. There are probably the largest cohort of investors, which is the equity fundamental investors. They look at securities, they make a call on whether the earnings, for simplicity, are going to go up or down, and whether the stock is going to actually reappreciate thanks to that move. Up or down, by the way, like you can be a short seller and be fundamental. Then there are like if you want, the technical investors of yesterday, which have all been effectively subsumed in today's world for the professional side into the quants. And quant people are like people in the Renaissance technologies, the hedge funds, but also in the market makers. They are the people that look at market for recurrencies. I'm going to say something silly, but you might be discovering that, like, every third day of the month, if the market, if the moon is full, something happens to the market. I'm being facetious, but only up to a point. Believe me, like, quants will try and test anything. And if they find the regularity, they don't need a story behind it, because they trust their statistics. They are a power force in the market. At this point, between market makers and quants, they make up the large and vast majority of trades in the market, and their alpha is based on their statistics. So we're circling around the fact that to make money, to use options or not use options, you need a view. Some people might be getting their views from articles in the press. Some people might get in the views because they think that some products are just too good for their companies to not do great in the next 10 years. Alpha is a concept that's based on your views, your style, and also your investing horizon. There can be alpha trading on a swing basis in the next 10 days or next 2 months. There can be alpha in trading, what it would be called investing, for the next 10 years. If you had seen Tesla do what it could do 10 years ago, you would have been a fantastic investor. Some people have done that, and they've been rewarded. Now, if you have a view, you need to be able to see it through, whatever is your horizon. And so we're going to move to structuring. Structuring is a way to say that I need to package my risk management policy around my trade. So let's start simple. Let's abandon Tesla for a second, just to move like into global macro space. I believe that treasuries are a fantastic buy, because the Fed has probably it's going to give us a one and done kind of rate hike. So the Fed cycle is probably done for this cycle. Excuse me, the hiking cycle is probably done this time. And so I want to buy treasuries. Good for me. Buying treasuries, even though they're a safe asset, is still something that carries risk, especially if you take the long maturities, 10 years, 20 years. So you need to be ready and aware that, even though you're right in your horizon, in 1 year time, maybe, you might be wrong in the next month. And nobody has infinite risk tolerance. You might be putting this trade on and you're saying, I don't want to lose more than 2% of my portfolio, 10% of my portfolio, whatever it is. Nobody has infinite risk budget. So structuring means how do you want to deal with the fact that you might be wrong in the short term, even though you're right in the long term, or that you might be wrong, period. All professional investors have had many trades where they just got it wrong. You need to cut at some point. How are you going to cut? There's a million ways to go around it, but effectively either you decide to cut your position gradually or all of a sudden, or you find some options that do that for you and you pay the price up front. And this brings us to the last point, which is reloading. Reloading is simply the fact that the best investor is the investor that doesn't lose money. I'm making obviously a theoretical statement, there's no investor that never loses money, but conceptually, if you knew a way to never lose money, you could invest on coin flips or on securities you know nothing about, because your risk management is so good. What is the goal of proper risk budgeting and reloading for an investor with a view? You might be wrong for the next month, but very right in the next 3 years. You don't want to be completely out of the trade, out of the market, cut off in your portfolio if you're wrong today. In many professional environments, especially in the very popular multi-strategy funds that are extremely successful these days, I'm going to say Millennium to mention one out of many, risk managers are very much on the shoulder of portfolio managers, and they impose very tight risk constraints. Pretty much each of these shops works with a strike one, strike two, and then out approach. You have given a maximum loss in your portfolio, let's call it 10%. So you're out you're down 3.5%, orange yellow alert. You're down 6.5%, orange alert. You're down 10%, that's the door. It's very, very, very tight. And so you need to be aware that your views are probably not unfounded. You've done a lot of research and whatever else. Now, If you don't want to get a red card, a red alert, and be booted out of the door, you need to be aware that you can put all your capital at risk today. Where's the lesson for a non-professional trader there? We're all facing the same issue. We all want to trade the market because we find it intriguing, fun, and we like the opportunity to profit from our views. But oftentimes, risk allocation is something that the retail space focuses less on. And the press is full of examples. Just go on. Let me say that the classic place for seeing the worst loss in the industry. Go on Reddit and Wall Street Bets, and you'll see people flaunting the amount of losses that they've managed to achieve. And that's a classic case of reloading on the wrong trade in the wrong amount. So you see the triangle. You need to have a view. You need to structure it in such a way that you can stay in the trade for the long term. And I'll close it with what I mentioned about being wrong in some cases. Your ability to reload and to structure needs to take into account that you have a limit. You will find the moment where you want to just get out. Please.
Yeah, I was going to say, so it really sounds like whether or not you're managing, a $100 million fund or a $5,000 personal account, it really makes sense for every investor to kind of know the max loss that they're willing to take on their view. First of all, come in with a view, an educated view of where they think a market or markets are particularly going. Come up with basically a game plan of what instruments can help them achieve that, and then also know their exit strategy as far as if things aren't going as planned, where they should get out so that they can go on to continue investing and continue trading and continue to basically live another day, for lack of a better word.
Another day, definitely.
Again, just to reinstate, like you've been doing this a long time, immense industry experience. Could you share with our listeners an example, from your time in the industry of, one of the better option trades that you had or were part of, and sort of just a little bit of a context around it as well, so they can kind of just briefly, just a little bit of context around the trade as well, just so they can see kind of the full story behind it.
Yeah, absolutely. I think that one of the best trades that we've had in global macro trade within the scope of global macro trading mandates was definitely on treasuries. And it's a timely thing to mention because we've been through a moment of massive sell-off. We basically spent 2 years seeing treasuries selling off hard. The press is full of stories about this. But in reality, this that we've seen in the last 2 years, this hiking cycle, had a false start at this point 4 or 5 years ago. In 2016, we started to talk about, okay, well, this is a mid-cycle. The Fed needs to start hiking, and we need to start to looking at treasuries with a bit of care. There was a small hiking cycle or a small sell-off in 10-year treasuries that effectively took them over from mid 2016 to almost 2019. And this, we knew that something would be coming. The Fed was making the right noises. The economy was making the right noises. You can see that sometimes things are working well. But shorting treasuries is a beast because treasuries have so much carry against you. You want to, for the long term, you want to be long treasuries. They're a beautiful part of your portfolio. That they're the pillar of risk parity, and they should be in your long-term allocation plans. But for a trader with a mandate to study the Fed and understand when they start to sell off, they pose a challenge. It's really technical to short. So what we did that worked really well was to use the skew that you get in the option space for treasuries. And here I'm going to get technical, so let me try to lay it down as simple as possible. The price of options changes depending on how far from the current price of the security they are. In treasuries, the cheapest option you can get is the option that you can buy where the treasury bond or future in specifics is right now. As you move away from if you want to buy treasury options of that give you profit after a 3% move up or down, doesn't matter, but mostly on the upside, then they become reasonably more expensive because there are fat tails, especially for treasuries to going up. Now, the fascinating aspect of this is that you could do the following. Treasuries naturally go up when the market goes down. So the fat tail is on the upside of treasuries. That means that for treasuries to fall down, it's considered a case that's somewhat cheaper. The market doesn't really believe it. You know why the market doesn't believe it? Because for 40 years they've been going up. That offered us effectively a value opportunity at the time. The market was still pricing, and to a degree, even now after this big sell-off, is still pricing the downside of treasuries with much less weight than the upside, because the moment where everybody gets scared by the market when the equities fall, everybody buys treasuries, their fat tail is on the upside. That means that we could do some really smart structuring. To give you an example, we could buy three put options for treasuries to fall 3% by selling just one put option for treasuries to raise 3%. That gave us an immense staying power, and that was important because we didn't know when treasuries could move. Eventually they moved. They made the big move between 16 and 17. It was a very sharp move, which is great for these options. It went well past our expectation of move, and our leverage was fantastic. Yeah, sure, we had some downside. Again, you need to understand there is always downside, but we were like managing that downside on a day in, day out basis. But our risk return was 3 times the upside, 3 times the profit if treasuries sold off versus 1 time the loss. And if treasuries didn't move much, they just had carry, we had 0 impact on our positions. It was a very smart and articulated trade. Now, this is obviously something that was requiring a team of managers to look at it every day, and it required a lot of how can I say, structuring study. But there is a lesson also for an individual trader who probably has a job as whatever profession he or she has. And the lesson is the following. If you like options and you're engaged in them and you spend your time before placing your trade to study the vault surface, as we call it, which is like just the matrix that you see in IBKR when you load up your option chain, is what Trader Workstation calls it, you will find that there are opportunities. And if you leverage these opportunities, they will make your life easier.
It's kind of the touch on what we spoke about with reloading. I got to ask about a trade that maybe didn't go as expected, and kind of on that theme of reloading as well.
There is a structure that is it's a bad structure for any manager, like for traders and whatever else. It's a nasty thing. Let me try to describe it graphically. It's called a 1x2. You buy one call or buy one put, it doesn't matter, like you can use it on the upside or downside. You buy one call at the money. So you basically imagine a triangle, you start to make money up to a point. Then you sell 2 calls or sell 2 puts if you're on the downside. And therefore, like, your profit is a triangle. But when the triangle is finished, let's say that you make money between 0 and 10%. When the triangle touches the 0 profit axis, that's where your losses start. So if the market goes up, let's say 9%, you've done well. If the market goes up 12%, you started to lose money because your profit, the 1x2, but in the 1x2 is only between 0 and let's say 10%. Why is it a tempting strategy? Because it doesn't cost you anything if you're wrong. You buy one option at the money, you sell 2 options out of the money, your net outlay of insurance is 0. And that's because you decided to take a lot of losses if the market goes too much in your direction, if you are too correct. Now, it's for everybody who's listening and is curious about what I'm talking about, just Google up the payout profile of a 1x2. You will see what I mean. You don't lose money if you're wrong, but you're losing money if you're very right. And that is the most frustrating thing for a fund manager. Sure, it's fantastic to have a 1x2 when you're wrong. You say like, ha ha ha, I survived and I'm unscathed. It's exactly what I was planning to do. Great, well done. The problem is that then if you're right and you start to become very right, you're thinking, what am I doing? I should have been making profit because my views were correct. And instead, I'm actually like nursing losses. So the temptation of 1x2s, everybody feels it. The 0 deployment of premium is something that's enticing for anybody. I honestly have never seen them work. In the treasury case that I mentioned before, we also had 1x2s, and those did not work. We had to manage them. it literally like hour by hour to make sure that the risk was not coming against us. I think that in some cases we even made money, so we were not too wrong. But the stress of managing this structure makes it completely not worth the risk.
Right. So if it goes past that second strike, then your losses start magnifying because your long option is only is covered by the one short, but you have that extra short option that's going to start generating losses at an exponential rate for you as you get more and more right, as you said, on the stock price, but more and more wrong on the strategy you chose.
And more and more wrong on the other side. Yes. Exactly right.
I want to take a step away from the professionals for a second and just kind of concentrate more on the retail traders and investors. And you touched on, a little bit prior in a kind of an introductory question stuff about the role options could play. But in your opinion, for retail investors that don't have access to entire teams of quants and PhDs and super smart people that are spending their whole day analyzing markets, what role should options play, if any, for retail?
So I think that it depends on your trading on your horizon. And let's split any individual investor. And by the way, we all are individual investors. Aside from our profession, we all have a PA portfolio that we run. For the part of your PA portfolio that is meant to be there for the long run, I don't think you should be engaging with options that match. And that includes if you want classic strategy like call overwriting and whatever else. That's a tactical kind of allocation. And in our long-term portfolios, we are not that active. We are risk premium takers. Why does your pension make money? Because for 30 years, you've been a receiver of risk premium. Risk premium is just a fancy word to say that you're holding risk and being compensated for it. And the interest of your treasuries is risk premium. The dividend of your stocks and the appreciation of your stocks is risk premium. So if you're thinking about your portfolio split in two, the long-term part, just let it be. It's like a tree. It's going to grow. And when the day comes, it will make you happy. But obviously, this is IBKR. And if anybody who's here is probably as passionate as we are about the short-term size of investing, let's call it trading, but let's call it trading in a positive way. Even a 1-year horizon can be a trading horizon. In that sense, I think that options are almost, I don't want to say mandatory, because some people are very comfortable with trading what we would call delta one in the industry. And what I mean is simply outright positions, be them futures or stocks or whatever, currencies. Everybody has their own niche in the market. But I think that especially for people that are making their first steps in the market and they don't feel too comfortable about the risk that they're taking and they might be panicking, options are a very neat way to take their first steps, which, by the way, explains their popularity. If you notice the inflow of traders that we've seen in the market in the last, let's call it 4 years, from 19 onwards, options have been immensely popular. And I'm glad that people are using them. As long as they're careful about some of their tails, they become an easy way to take your risk, see how you like the markets, find your niche, find your style. Make no mistake, they will not save you money if you're wrong, but they will let you play another day, and they will do it in a way that doesn't break your bank. Let's not forget another case in which something very, very complex happened to people not using options. And IBKR knows what I'm talking about, because some of this action was actually taking place on the platform. You guys may remember that at one point, a few years back, the future on oil went to zero for technical reasons. And at that moment, a lot of traders that didn't really understand the technicalities of that future started to buy the future in spades, because if the future is trading at 4 cents, I might buy, I don't know, whatever, $1,000 and have an immense exposure. That future went to -40 at delivery or slightly before delivery. And that created some considerable losses for those holders of risk. Why is that? Well, because that's uncapped risk, especially in future space. The reason why a future can go negative was very technical in that moment. We don't need to go and rehash the story, but the fact is that someone put down let's say $1,000, thinking that that was the most they could lose, and discovered that that was not true. Options insure you for that, and therefore it's a good premium to pay if you're a newbie to make sure that you can trade today and trade again tomorrow.
Yeah, no, back to the reloading theme. Exactly, right?
Exactly. It's all there. It's all there.
With everything, technology has just improved so much over, again, exponentially. Toggle AI is a perfect example of how technology can help, investors and traders just sort through information, makes tools more accessible, stuff that was not accessible to the everyday retail investor / trader 5 years ago is now almost, every day included with platforms. How the tools available for option trading, how would you say they've evolved or changed since you first got into the industry? What are some of the main functions of the tools that people may use? Obviously, the Trader Workstation has a plethora of tools included, such as like Probability Lab, the Right Rollover tool, and so on. But just like in a general sense, like what have you seen that's sort of really come into play over your investing career?
Well, look, on any desk that trades options, you have option pricers and option structurers. They are not always the most friendly of tools, but they do a decent job at like showing you what your payout profile looks like. And for those who are listening who know about like the technicalities of options, your Greeks. The Greeks are just numbers associated with options that tell us what this it's the DNA of an option is called the Greeks. How they're going to react to the market and to other changes in the market scenario. Some of these tools have, in a very, I think, virtuous way, started to trickle into what is available in the space for traders. And I'd say, like, Trader Workstation, whilst it's certainly like a comprehensive software, and therefore, like, almost professional in its capabilities, does an excellent job at letting you compose and study options. As someone who uses it almost every day, I find that the capabilities that like TWS offers are almost on par with like professional software, and especially things that let you see the payout of the option, the probability profile, as you mentioned, are very, very important. I invite anybody who trades options on IBKR before they trade to go and look at that specific sub-window called the payout profile. You will be surprised at the numbers you will see there. Sometimes we trade these options and we don't think about what they're doing in the tail ends of the spectrum, on the upside and the downside. And poof, all of a sudden you see that like your gains or losses are magnified. And what you thought was like, a $3,000 trade, maybe has a far tail of downside of $60,000. So one advice, if I were to give only one advice, is use the tool that in the specific IBKR gives you, or any other broker, just to be like balanced, and plot out your payout profile. Look at the probabilities. You will get surprises sometimes. Then beyond that, you probably want to benefit from tools that can help you understand the market probabilities in a skewed way. Let me explain what I mean. It's again the topic of alpha. In a skewed way, meaning like option pricers will always tell you a balanced view of probabilities. We just like take the current shape of the volatility curve and tell you, well, based on the market, you tend to have like 52% on the upside, 48% on the downside. Tools like Toggle take it one step further and say, yes, but studying everything else around this stock or this commodity or whatever, looking at the fundamentals of this stock, the price performance of this stock, what the economy has done, we think that there is a skew, and that maybe like the most reasonable scenario is a 5 to 10% appreciation. Tools like that allow you to step up your game. Why? Well, because options are fantastic to tailor your investing. If you grow convinced that this specific stock you like has a 25% upside probability, you have a fantastic chance to put down a very reasonably small amount of money and put out a trade that gives you like 4 to 10 times the profit. Because you're saying, you know what, I believe that the announcement that's coming with the next earning release, or like what Toggle has told me about the trend of the market, or what I read about it in the Wall Street Journal, makes me convinced of the upside. You can structure in such a way as to make the most out of it. So options really shine if you have a view and the view is compelling, because then the risk return will become fantastic. You can put down $1,000 and get back like 10 grands, or whatever is your natural investment space. So I think that what I highlighted now is like twofold set of tools. You need the technical tools like TWS to price your options and look at what they like, display what they look like. And you need the alpha resources to build the view for yourself. I say resources and not just tools. Things like applications like Toggle, they're tools. They let you test specific scenarios and build numerical confidence. But even just reading the earnings report of a company is going to be part of your process to build the view on that company. Once again, we're talking companies, but I want to spread this to all the investors that are listening and that might like their, I don't know, natural gas trades or the euro dollar trades, the XY. Again, we mentioned treasuries. Whatever you trade, it's always the same: conviction and structuring.
Giuseppe, this has been a great discussion. Thank you so much for coming by the IBKR podcast. For more from Giuseppe and Toggle, please go to our website under education to view previous webinars and podcasts, as well as keeping an eye out for any upcoming live events. I also want to remind everyone that you can find all our podcasts on our website under education. Scroll down to IBKR podcasts, or on Spotify, Apple Music, Amazon Music, Podbeam, Google Podcasts, and Audible. Thank you for listening. Until next time, I'm Jeff Praissman with Interactive Brokers.
Thank you very much, guys.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at ibkrpodcasts.com. And if you're interested in learning more about Interactive Brokers, visit ibkr.com. We offer more trading education material, such as webinars at ibkrwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at ibkrquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and if necessary, seek professional advice. Options involve risk and are not suitable for all investors. For more information, read the characteristics and risks of standardized options, or ODD, which may be accessed through the link found in the show's notes or podcast description page. IB Global Investments, LLC, a subsidiary of Interactive Brokers Group, Inc., the parent company of Interactive Brokers, LLC, is a minority owner of Toggle AI. Day trading can be extremely risky and may not be appropriate for individuals with limited resources, investment experience, or low risk tolerance. Please review the day trading risk disclosure statement before deciding whether day trading is appropriate for you.